Sandip Agarwal, a fund manager at Sowilo Investment Managers, joining us this morning. And thanks so much. It's a pertinent time to be talking about this, Sandip, because you've had a statement that came through from Goldman Sachs Chief Executive Officer, and this is something that is proving to be a shot in the arm for IT companies globally. And it's something that I think a lot of people have said in the run-up to today. It's just that some statements get a lot more attention. What do you make of that? The fact that it's going to be costly and it's going to be time-consuming to have adoption of enterprise AI, and that's where IT companies stand to gain.
On the show.
Yeah. Go ahead.
I think I 100% agree to what has been said, and very interestingly, a few years back when I was attending a technology conference, what I came to know that the whole audience was talking about digital technology, but at that time also the enterprise digital was only 1% of the total spend. So technology takes a lot of time. It is a very badly in a very complicated and complex way integrated wires which no one wants to touch, because you don't know what will be the repercussion of that on the business. So I would say that while AI is a great thing and it will help a lot of things, but if you see all past disruption, they have always increased efficiency, but they have never reduced the total spend. Although AI is going to cut down efforts by 20-30%, but I think the quality of outcome will improve substantially, and that is the reason I believe that it is a wrong way to look at overall tech budgets will go down or software budgets will go down or software services budgets will go down. I would rather put that you will get much better output, much better outcome within the same amount of money, and if that happens, then I think the services firms will be the least impacted. The most substantially impacted will always be the software and ERP product companies, and then the least impacted will be the software services, where we are positioned. But yes, it is a lower growth for longer, that is for sure. So we are going to see 3-4% deflation because of AI for next 4-5 years, but still, even in that case, we will do well, and because of rupee depreciation, now the earnings growth will be phenomenal. So I think the multiple which the IT index is now trading, and barring the ER&D companies, it is a very good space to be in. I think good return in near term can be made in the index.
Sandeep, good morning. If that is indeed the case, and I know you were constructive because you mentioned this about a month and a half ago, that this was amongst the first times that you started buying into IT. If you were to put incremental money to work in IT, where would you put incremental money to work? Would it be the mid-sized companies which are more agile on AI? Would you get on large caps? I know you maybe can't talk stocks, but what variety of stocks is in IT?
So, right now is a situation where you should go all in. Basically, if anything you look, it is reasonably priced, you can buy, except ER&D companies. And I have said my reason for ER&D. ER&D companies, I will give you a call when to buy. Let this Ukraine-Russia war get over. After that, maybe 4 or 5 quarters later will be the right time to buy. But IT services, whatever you get in 1 to 1.5 PEG ratio, buy that. I think next 2 years, you will see at least 16-17% PAT growth. And if that is the number, then I think the stocks will at least give 20-30% return from here, which is a very good return in current market.
Sandeep, hi, good morning. I think that's really the headline from your interview to us this morning. If you have money, please go all in on IT. And like we said, you're the first one to call out that complete shift in mood. Does the fact that there is going to be faster AI adoption not worry you at all as a result? Let me ask you a very fundamental question. You seem to be shrugging off the concerns, the basic concerns that have slowed down IT growth so far.
So, while by profession now I am a fund manager, I manage a PMS, but by heart I am still a tech analyst. So I believe only in numbers, rest everything, I don't go for the noise. So when I do the numbers, and when I was doing the number 15 months back, I felt that the index should correct 40-50% at least to justify the prices. And when I did my number again a month back, I believe that at least 20-30% jump in index is minimum required to justify. So both the times, it is all about numbers which matters, and I don't go by anything other than the numbers. So if you see last 15 years since I am tracking tech in the sell side earlier, I have always believed in numbers, and I have given call based on number, and generally I take very bold calls. And this time also a month back, on all the channels I have said that this is the time to go all in IT, and I think that there is money, but I am not at all recommending any of the R&D companies. I think they are massively overvalued, and there will be a big impact of once this Ukraine and Russia war gets over.
So point well made, and you're not liking the ER&D space. So I guess in a sense, the best way to do this is to take the whole pack and to eliminate, right? So therefore, you've already eliminated ER&D. The best way to play this is to, of course, have a more strategic, a concentrated kind of an approach if you are going into the IT space as well. So what are the parameters that you've looked at, and which stocks, and these are not recommendations, but which stocks do you like?
So as I said, we like all the stocks, and the reason is the pay ratio. See, I am never carried away with the PE ratios because they don't give any picture. So now if you see with let's say 8-9% is the revenue growth, which I am expecting. Out of that, you take out the 3-4% deflationary impact of AI. So we are talking about 5-6% dollar growth for the large companies, and now rupee has depreciated by almost 11-12%. So you add that benefit, so we will get 13-14% EPS growth. Now many people based on data are suggesting that in past rupee depreciation has never benefited, which is a correct statement, but you have to remember that last 5 years where the benefit of rupee depreciation has gone, it has all gone to increase the local resources, because after 2014 there was immense pressure to increase the local talent. From 25-26%, our local talent for most of the IT companies today is 68-70%, and that has taken away almost 7-8 or 10% of the margin in last 5-6 years. So now I don't think that we have to increase local talent more. Plus AI gives you a lot of benefit, and COVID has taught us how to work remotely. So I think the places where all the tech companies have to invest heavily, those all pressure points have gone away. So whatever rupee benefit now comes will show up in numbers, and all the companies are running a very tight ship, and they are not required to maintain large bench. AI has enabled that. So I think now whatever benefit we get of rupee also will flow down. So it is not a call that dollar earnings growth will be 12-13%, rupee earnings growth will be 13-14% maybe. And from that perspective, 1.5 peg ratio is very low given the quality of management, given the cash balances of the companies, and given that we are in an indispensable global market leader. This is a software factory of the world. I have always said, when I have negative on the index, I was consistently reiterating, I don't even doubt our business models, and I don't think there is a doomsday for the industry, but these multiples are not justifiable where they are trading. Now after 40-50% correction in last 14-15 months, I think now multiples justify a lot. In last 1.5 years also, these companies have made some money, so that further makes the deal better. And now rupee is a sweetener. So I think everything is coming together, and there is no point to be negative. So I again would say that if you don't want to do specific cherry picking, buy the index. That will be a good call.
Okay, yeah, see, that's exactly the point. Sandip, thanks so much. And it's heartening to see you so bullish on the sector, particularly when just about 4 months back when we were speaking, it was a completely different picture. Thanks so much for taking the time.
Thank you.
Yeah, the screen's showing it.
It is 3% up.
Yeah, 3%.